Those fresh beats mean one thing. What do you think those fresh beats mean?
It means it's time for Freightonomics.
It's time for our weekly chat.
Let's do it. This is Freightonomics. I'm Anthony Smith.
And I'm Zach Strickland.
I do econ stuff here at FreightWaves. I am the lead economist and director for market experts, and you are?
Director of Freight Market Intelligence.
Intelligence. I want intelligence in my title.
Yeah, it makes me sound smart.
It does, but this is Freightonomics, where we bring freight and economics together, and I will be monitoring, as always, LinkedIn. We're streaming right now. If you are watching between the hours or times of 2 to 2:30 Eastern Standard Time on Wednesday, so get in those comment sections. Let your voice be heard, because we have a couple interesting stories today, Zach.
Yeah. The stories are kind of taking over the show a little bit here today. We'll get to the stats and the data of the freight market and the economy here after a bit. But first up, we've got some really, I think, pertinent stories. We don't really necessarily want to rely on talking about earnings too much. We got, Andrew Cox and Kevin Hill to talk earnings on Great Quarter Guys that airs on Tuesdays with great detail. But again, I am a financial analyst. Or I was a financial analyst at one point in my life, so also a finance major. So these fascinate me. I want to make sure that a lot of these, I'm not going to break down an income statement, but I do think it's fascinating to see what these earnings calls may tell us about what's going on in the market, how carriers and shippers and brokers are all managing what is proven to be an extremely volatile time.
Yeah.
And it continues to be so as we see the freight market really ride a roller coaster here over the last couple of months. So we're going to talk about Knight-Swift and their earnings here in a little bit. But first up, we have, I'm going to get a little political. And I say that in the sense that I don't want to be political.
Yeah, right, Zach. As soon as these cameras come off, I always hear you spouting your political nonsense left and right.
I am not a political individual, but I do think that it is important to break down certain topics that may have been politicized in some way, and hopefully, everybody can make their own objective opinions about what they think about it. So we have a couple of stories. So YRC, their loan that they got from the federal government, $700 million bailout loan, 30% equity in the company, and that has come under scrutiny. YRC is Yellow Roadway. They had a huge merger, LTL company, fourth largest LTL company in the United States. Used to be the largest back in the day in the 90s, Roadway. It's hard to talk to somebody in the LTL industry that's been in the industry for the last, over 15 years, 10 to 15 years, and not talk to somebody that has worked at Roadway at some point. A lot of the industry's strongest performers came out of that environment in the 90s. Yellow has become not necessarily quite, they've lost a little bit of prominence in the LTL industry, in the LTL world, less than truckload for those of you that don't know, here in the last decade or so. And a lot of people will state that that's due to, a large part of that's due to the fact that they're still one of the only unionized carriers sitting in the United States right now. Of course, they've also merged with a few other carriers that are unionized, and along with being in a union comes that notorious pension plan. Pension plans, of course, we talked about this when this story first broke, kind of an outdated mechanism. They really don't work in the long term, especially in today's environment. Back in the 50s and 60s, people were working at companies for their entire careers. Then, not a huge amount of people to support on the retirement end. Over time, people are living longer, et cetera. It's the same problem that occurs with the Social Security Administration and why we're going to eventually run out of money on that. Pensions, no different in the private sector. Very outdated mechanism. A lot of people don't work at companies for more than 2 or 3 years at a time now. It's been proven that you can actually accelerate your career growth by switching every 3 to 5 years versus staying with the company.
Right.
Obviously, that involves some level of risk tolerance as well. But, neither here nor there. It's come under scrutiny that this bailout, which, they state was part of the CARES Act, basically stating that they are an essential business service for the government. They supply over 68% of the LTL services for the Defense Department. And this whole mentality, this whole policy was driven by the fact that, companies like GE really are a staple for the the Department of Defense, I should say, military support. And a lot of the critics of this bailout are stating that YRC is not as critical as somebody like a GE, who is literally the only supplier for the Defense Department.
Yeah.
And that being said, they also state that this is not the best use of taxpayer money because YRC was already a financially struggling company, coming into bankruptcy claim or, threat of bankruptcy numerous times. There's evidence, you can read this article on FreightWaves.com. Todd Maiden does a fantastic job of covering these types of things. He's a financially minded individual. But again, taxpayer money being used to prop up an organization that people don't really feel has a strong financial background. Their own board basically took cash at the end of 2019 versus shares in the company. So they were able to be compensated in one of two ways: increased ownership or just straight cash.
That really tells you where their alliances are and how confident they are in their own company.
Yeah, it's not a great look. It's not a great look for the the company itself, for sure. Of course, their stock fell on this news, but it's also not a great look for the government and their bailout. Again, subsidizing this company that has we're subsidizing pensions and all that, and that's obviously something that people can debate on their own about whether or not you think that's the correct measure or not. Ultimately, it's up to the person who's deciding, or the people deciding, on whether or not to bail them out, whether or not they're essential or not. But it is worth paying attention to, as this is a huge move with the government. There definitely needs to be oversight on these types of things. The odds of the taxpayer getting a return on this investment are little to none, according to the committee. Due to the fact that they're already struggling, and now you're kind of propping them up.
Yeah.
And they have a lot of things weighing them down, such as this, they have this pension plan. It's destined to fail. An increased costs compared to their competition due to the unions. Unions increase your costs because you have to support it, and there's obviously a wage in there that's involved that, is traditionally higher than the non-union companies, non-union carriers. So the real question is this a financially viable investment by the government? I'll let you make the decision, but this is absolutely something that should have a lot of eyes on it moving forward, especially, there's still a lot of, struggling carriers out there, a lot of struggling companies, as the COVID crisis kind of continues through the market. What do you think?
Yeah, I'm completely with you. When you're looking at this, thinking about the factors of prolonging a struggling company. One, I think that's one of the things that we were really anticipating across the board in many different industries when we're looking at some of these protection plans being put in place for companies that were already financially in a bad place. And so this is like just extending that. But now, as you mentioned, at the taxpayer's expense. And the other thing is that I don't want to use the word exploit, but with a limited oversight with a lot of these bailout plans, I think a lot of these are prone to being exploited because I think the government wants to get the money out as fast as possible. There's going to be a few bad actors. There's going to be people that need it, companies that don't need it, and let the rest fall where it may. But so I think when we're looking at this is an example of what we don't want to see kind of happen in the industry. And we have comments here in the LinkedIn section already. Donald H. saying hello all. Derek King in here. Kyle White saying, I really hope you bring up YRC Freight. Kyle, interested in hearing your thoughts on this whole situation. So let's hear from you in the comments on how you think this has all been playing out. But definitely from my end, it definitely sounds like this is one of those prolonging something that doesn't need to be prolonged.
They were already struggling. And again, you're talking about the government. It's not the government's job to make sound investments in publicly traded companies.
Yeah.
Their job is to facilitate sound investments and help others make the right decisions, et cetera. The reasoning that they're using here is, of course, that they are a support structure for the government itself. Therefore, they're going to do a little back scratching because they're helping them. But that being said, this entity is already in trouble before, and for you to kind of, maybe you need to look elsewhere, on your end versus just trying to facilitate something that's already kind of dying on life support as it is. Again, I'll let everybody that's watching or listening make that decision on their own. The next big story of the day, and, before we get to Night Swift, the Virginia law.
Yeah.
Do you want to lead us off with this one, Anthony?
I mean, we have this is a piece that was put together by John Gallagher, our Washington correspondent, another talented writer, and it's showing that carriers may face penalties, shutdowns under Virginia COVID-19 regulations. So Virginia taking it on their own to really instate COVID regulations for different businesses within the state. Yeah,
this right here is, to me, where we start kind of stepping over the line. Because to me, if you're gonna do something like mandate mask wearing, that has a direct, definitive result. There's science backing it, et cetera. Whether or not you land on the side of anti-mask or mask, that's another story. But they have a definitive outcome from this. There's something you can measure, sort of. But there's still a lot of medical science behind it, et cetera. It's very logical in its procedure. We're in a crisis mode, if you will, and there's a lot of reasoning behind it, and to an extent, a measurable outcome. This, to me, is a lot of bureaucracy, and it doesn't necessarily have a measurable outcome. I mean, you can argue that it does in the way that, hey, if you make them institute policies, you're going to see something happen. I just don't see it. So, basically what it's stating is Virginia companies are required to classify employees by a risk level: very high, high, medium, and lower. Stopping right there. That sounds like extreme subjectivity.
Yeah, very much so.
There is no definitive measurable way to establish whether or not you're very high, high, medium, and lower risk, just looking at the population. Like, somebody's very high risk, exposure is somebody else's medium. If you're in the medical field, obviously very high. To me, that's almost indisputable.
Yeah.
But then there's this high, medium, low. How do you what's the next step? Like, who's these people that deal with medical professionals? And then you have, I don't understand where you can have carriers that'll go and deliver to medical supply people that have no interaction with doctors, but maybe that's a medium. I don't know. Yeah. So right there, I'm immediately kind of like, this is much ado about nothing. So based on workplace hazards and job tasks, establish policies for employees to self-monitor for COVID-19 signs and to report symptoms. Are you kidding me? Hey, Anthony, I coughed twice yesterday.
I'm not reporting you.
I also had a sneeze.
Okay, now you're pushing it.
So, exactly. You see where I'm going with this. This to me has now crossed a line of, it feels highly political. Yeah. And very dysfunctional. Like, I don't see the outcome here. There's nothing measurable here. How do you enforce a company instituting very high, medium, lower? How do you establish self-monitoring policies? You have 45 days, by the way, to establish these self-monitoring policies. What are those policies? I mean, okay, so obviously you can take your temperature.
And self-monitoring is like, I'm self-reporting my own weight loss and fitness progress.
What? Is that a thing? It's the only thing I can think of that you can objectively monitor that you can say has nothing is, I have a fever, or I don't. Yeah. So this to me is, and this scares me in the way that now you're going to get into this, say legal law enforcement comes into your business and now starts saying, it's basically saying, do you have a fire escape plan?
Yeah.
You should have a fire escape plan.
Right.
But there's no real, explanation of what they're looking for in the fire escape plan. They just want to see that you have some map on the wall that states clearly, go to a door.
Yeah. Yeah. And when I'm looking at this is like, I can see so first off, when I'm looking at how COVID-19 is playing out, I definitely think it's going to be difficult to roll out a nationwide plan.
Mm-hmm.
And I definitely agree that, it's from the beginning that we knew it was going to be a state-by-state thing. And even within the state, there's going to be different regions within each state that are going to vary from some of the other hotspot areas.
Yeah.
So I'm all for state-by-state solutions, because what's good for New York isn't necessarily good for Arizona, and what's good for Tom in Arizona isn't necessarily good for, I don't know, Matt in Las Cruces, New Mexico.
And I think some of the New Yorkers would argue that that's not even true for them, because you have New York City and then the rest of the state, which is largely rural.
Yeah, and if you're anywhere like 1 mile north of the city, it's upstate.
Yeah,
it's upstate.
exactly.
So, but definitely when you're looking at a state by state solution, I am all for it, but I don't think this is it.
No, this feels inconsistent and confusing. And as it pertains to the freight market itself, you're talking about carriers that operate in multiple states. You cross borders. It's already been noted that it's a state of confusion for carriers operating across borders. As you enter one state, and it's like, well, what's their regulations? How are they handling it? They're having trouble regulating it from shipper to shipper, consignee to consignee.
Yeah.
So this just adds another layer of complexity, and I just don't see a measurable or functional outcome.
Right.
I mean, the good news is that it's set to expire in 6 months. At least they did that right by putting in a self-destruction mechanism to it. But still, 6 months of this, I don't know how to measure it.
Yeah, and it almost seems like it's one of those things where maybe it was put in place for a good look. Like, hey, this is what we did during times of COVID. We took steps, even if the steps were completely pointless, we took steps nonetheless. And so when we reflect and look back at actions being taken, hey, look what I did.
Yeah. Yeah, and I just don't. That's exactly right. That's what it looks like. Is it's a political maneuver, saying that we did something. Okay, waving your arms around in the air doesn't really do much good if you're just waving your arms around in the air. My opinion. So that's hopefully this is not something that takes hold across the country. In my view, I think that this is largely worthless. And only adds to the confusion of the world that we're living in, and obviously if you're a shipper, even this just makes your facility less feasible in Virginia.
Yeah.
Like now you're going to start seeing rejection rates going up to cover your freight, because some of the carriers are probably not going to want to. And I don't see this happening on a mass scale, but it's certainly, I think it has the potential of adding 1% or 2% to your capacity situation, at least detracting from it. That being said, let's move on to the Knight-Swift earnings call. So
big one.
This is obviously the biggest carrier in the United States, a for-hire carrier. That is, they have over 18,000 power units, and that did decline year over year by about 600 or so units. Important to note. They did at one time have over 25,000 units, Anthony Smith. Don't know if you know that. So again, huge carrier, mega merger back in the day really had a big impact to the freight market, as you now have, again, largest carrier in the country for hire, still accounts for less than 2% of the overall capacity in the United States.
A lot of fragmentation there.
A little bit of fragmentation, but nonetheless, they do command a lot of, influence in the environment that they exist in. So nothing terribly surprising on the declines. So year over year, everything was pretty much across the board down. The one thing that was surprising, and again, it was down, was their OR. OR dropped from 87.8 to 87.6. They actually did better in the second quarter of this year versus the second quarter of last year. And everybody's talking about the second quarter for a carrier being the rock bottom.
Yeah.
I just want that to sink in for a second. we just had the single worst month in freight history potentially economically, arguably, depending on what your thoughts about the economic stimulus and all that were. But as a functioning economy, people going to work every day, producing things, having services, being active, April 2020 will probably go down in history as one of the single worst economic months in history due to COVID, as that was the peak of the results. Everybody bought a bunch of stuff in March, then they shut down in April. I mean, they were completely shut down by April, didn't get back into it until May. It was basically when everything was overlapping. And now this month is part of this quarter that Knight-Swift is reporting, and yet they're saying that they actually had improvement in efficiency, operating efficiency, their OR, which is operating profit, if you will. Yeah. So they had 12.5% operating profit effectively this month, which is amazing. So for every dollar that they made, they spent 87 cents on running that freight across the country. And it's impressive to say the least, at least to me. The fact that they beat the street isn't that special to me. A lot of these carriers came out and said, hey, we're going to change our outlook for the next quarter to be much worse. Again, just shows you how much uncertainty there is in the world. Every single carrier out there gave a downward revision to their expectations for second quarter, and yet here Knight-Swift is beating, and they did go down on their earnings per share, 58 to 57 cents, but it was a penny. I mean, so they operated more efficiently. They made less revenue, but they operated more efficiently. They obviously had some cost control functions in there, but also the fuel. Everybody's ignoring the fuel headwind here for the carriers. We actually saw, when we talk about this on our monthly market update, fuel costs on the wholesale side, the discrepancy between wholesale fuel and retail fuel was at its peak in April. They were basically paying you to pick up barrels of crude oil in April. And for a carrier that spends a ton of its money, roughly, anywhere from 5 to 15% on fuel costs, that's a major headwind when you're talking about being able to pass along a large portion of that cost, and then you're not having to spend any money on it because the retail side corrects a lot slower than the wholesale side. And so I think people are ignoring that there in the way that the fuel headwind for a truckload contracted carrier is probably a lot stronger than a lot of other people.
Yeah, I completely agree. And I think when we're looking at this is kind of reminds me of one of the earlier conversations we had when this all kicked off, is like just on an industry basis that larger, more prominent industries or businesses within the industry are going to do just fine, while some of the other smaller ones are going to have a lot more pressure. And I think when we're looking at someone like Knight-Swift, of course, one of the largest out there, they
obviously have some fuel contracts sitting around.
And they're going to be just fine. And their story isn't going to be the same for some of the other companies that are in that same arena. And I think this also plays into when a lot of people want to compare what's happening with overall GDP and the macroeconomic numbers compared to what's happening within freight. And I think that also kind of shows that delineation there as well. But definitely interesting numbers just to see on that operation and efficiency numbers coming out from Knight-Swift for sure.
Yeah, and just to clarify, so the way that carriers operate is they generally have a fuel surcharge that they pass along to their shippers or their customers based on the retail price of fuel. And it's normally like a cost per mile. And so when retail fuel remains high while the price that they're paying drops, that's actually an expansion to the profit margin for a carrier. So normally, they obviously have it based on, the averages and stuff like that. So this happens, and then eventually when fuel goes back up, they lose money on that. So it's a trade-off. It's not like they're gouging the customers or anything like that. It's just the nature of the beast when you have a very volatile thing like fuel moving up and down in different layers. It's like different layers of the atmosphere moving differently there. Something else I wanted to note is that their deadhead percent So this is your empty miles. This is how they have to drive to go get other loads. They drop off their previous load, then they have to drive another amount or sit and wait until they can pick up their next load. Their deadhead percent rose pretty significantly from 12.9 to 13.8% quarter over quarter. So that means that they dropped their OR while simultaneously reducing their efficiency on their drive time.
Yeah.
So there's only two ways that can happen. You're making more money.
Yeah.
So you're increasing your revenue or your price, which again definitely lines up with fuel being higher here. That fuel efficiency going up, or you're basically being more effective with your pricing.
Right.
So you're charging for that deadhead percent. You're anticipating it. Something we monitor here at FreightWaves, obviously the tender rejection rates. We had two huge spikes of volatility in the last 4 months. A lot of that spike happened in the first quarter. March, obviously a big heated time, but June was the other one.
Yeah.
So there's the potential here that they were able to really take advantage of some tight capacity in the spot market. Now, I think they would argue that they are one of the lowest spot market active carriers out there. I think they've claimed in the past about 10%. Don't hold me to that one, but that's not a big percentage. But at any given moment in time, these carriers jump to the spot market whenever they feel like.
Yeah.
And so that will change their percentages. It's definitely not something that's locked in place. So that could potentially be another way that they were able to overcome this increased deadhead percentage stuff. Loaded miles went down. Again, goes right along with you're talking about deadhead percentage and increase. They decreased their tractor count. Revenue per tractor went down. Average length of haul slightly down by like 9 miles to 420 from 429. That's an interesting one to me. I always like to look at the average length of haul because that tells me what kind of freight they're moving. And we talked about it earlier in the year, like in March, April, the short haul volumes really increased. Long haul volumes didn't do much. Long haul in May took off. And then towards the end of June, we saw short haul start to make a comeback as well. So there's a difference between long haul freight and short haul freight, DC to fulfillment to end user, a lot of changing supply chain activity going on out there. But at the end of the day, adjusted OR percent for the entire company dropped from 85.8 to 85.5%. They killed it.
Yeah.
They killed it. I mean, and again, and I can't reiterate this enough, the takeaway for me is that we just had one of the worst freight months in history in April.
Yeah.
That tells me that May and June weren't that bad.
Right, to make up for all of that.
And something we know here at FreightWaves, June was obviously an extremely strong month, much stronger than even I anticipated.
Yeah.
As I have to give Craig Fuller credit for calling, even though his reasoning may have been flawed. But it was a very surprising month for freight in general. So
most definitely.
I think this bodes well because we're watching right now. We're watching the freight market continue this torrid bull run. Craig and I debated yesterday on how long we think it's going to last. I don't think it's going to last that long. I took my my bear stance one more time.
Yeah.
He took the bull stance that it's going to be in a continued acceleration due to various reasons. Be sure to check that out on FreightWaves.com if you missed it yesterday for the 3PL event. But it is an interesting thing to note that all of our expectations, we all kind of think, I'm an analyst, so I natural tendency is to lean bearish,
right?
Because as an analyst, you've seen so many things that point you down that road of bear. It's hard to be optimistic when you look under the hood of a lot of things and see what's going on. This one, I looked under the hood, and I'm still admittedly undecided on what's going to happen moving forward. There's so many anomalous patterns. We're so disconnected. Yeah. The freight market itself it remains disconnected from a lot of traditional macroeconomic figures, as you can attest. Industrial economy doesn't necessarily drive as much as it did in the past, and that continues to be the case today. Supply chains are moving things without demand. Yeah. They're changing these are mechanisms that have nothing to do with Bank of America credit card data. Yeah. These are movements that occur, they're just different. It's revenue they had in the budget or money they had in the budget that's allocated differently now.
Yeah. It's a lot.
It is a lot. And so I think there's a lot to take away from this in terms of a lot of optimism for the third and fourth quarter for sure, because
Definitely.
again, I still think that we're going to see a contraction just because this is such an overheated